Okay, we've looked at stocks and mutual funds. It's now time for our wheel of investments to take a look at bonds. And we'll take a quick look at what bonds are. And this, again, is a supplement to the reading. You should be reading Chapter 14 in the Walker book. And this kind of walks you through some of the high points of it. And I'll try to make this fairly quick. What are bonds? First things first, instead of buying a piece of ownership in a company like you do when you own a stock, with a bond, you're loaning money to the company. So instead of borrowing money from a bank, they're borrowing money directly from you or to a government entity. Matter of fact, one way that our school often funds building projects is through issuing bonds, because what a bond does is it allows them to borrow money directly to the people and they can pay it back over a series of 20 years. So say we need money right now to build a building, so we can issue however many millions of dollars we need to in bonds. Let's say it's 20. We can issue $20 million in bonds so we can build the building now, and then we can pay that off, $1 million in principal over the next 20 years, for example. So bonds are loans to companies, they're loans to government entities, and that company or government entity is promising to repay. Now here, of course, is the issue with that. Bankruptcy happens, so there's where your risk is, but bonds generally are seen as fairly safe investments compared to stocks because they're generally going to provide you a guaranteed rate of return. And so they're going to provide you a steady source of fixed income. And what that allows you to do is balance and diversify your investment portfolio. So basically, a bond is a promise to repay the principal along with interest, which is the coupon rate. That's how much you're going to get paid each year by maturity, which is the date at which the bond will be repaid in full. So if you have a 20-year bond, you buy it now, it will pay you, let's say the coupon rate is 6%, it'll pay you 6% of whatever the value of the bond is each year. And then at the end of the 20 years, you will have been paid back in full. So again, bonds are loans. They're not shares of ownership. And I think that's an important thing to understand, that instead of borrowing money from the bank, they're borrowing money from you, essentially. And so you are the bank. You are loaning the money to the company. So bonds work by allowing you to receive interest payments on a regular basis, and then at maturity date, you'll receive your original investment back, which includes your principal. So the one thing about bonds is, as well, they're commodities. So let's say you don't want to wait the full 20 years to get paid back your principal on the bond. Well, you can buy it or sell it to others. And that may be more or less than the original price based on interest rates. So bonds have a price that allows them to be bought and sold over the term of the bond. And again, those things are set by the market. In general, bond prices are inverse from interest rates. So a bond with a low interest rate is generally going to have a high price. A bond with a high interest rate is generally going to have a low price. And you think that's somewhat counterintuitive because you think, wait a second, if you've got a bond with a high interest rate, more and more people would want to buy that bond, right? It's actually quite the opposite. Generally, really risky bonds are the ones that have high interest rates. You're talking about companies at risk of default or government agencies that really don't have a whole lot of money. There is a little bit of default risk with these bonds. There's a chance they may not get paid back. And so to get somebody to buy them, they've got to offer a higher interest rate. But the thing is, because these bonds are kind of what we call junk bonds, they have really shaky companies or shaky government entities behind them, nobody wants to buy them. So they have to offer a higher interest rate to entice people to buy these bonds instead of the safer bonds that are being sold at lower interest rates. But the risk of default is higher, so therefore fewer people want to buy them, and therefore supply and demand states that the price is going to be low. So there's an inverse relationship between bond prices and interest rates. So generally, safe bonds have fairly high prices because more people want to buy them, but the rate of return is not going to be as great on them because their interest rates are going to be lower because they're safe. Meanwhile, risky bonds, or what we call junk bonds, are going to have really low prices because nobody wants to hold them. But to get people to try to buy them, to entice buyers, they tend to offer a higher interest rate. Now, there's a couple of things to know. Bonds are often sold at discount, which is the price below the face value of the bond. And so you may see that discount rate that shows up. So you can buy bonds in the secondary market, especially at a discount, which is the price below the face value. So if the face value is $10,000 of the bond and you buy it for $9,000, you've bought it at a $1,000 discount. Now, one thing to keep an eye on is, do the bonds have a call feature? Because if they have a call feature, what that allows the issuer of the bond to do is call the bond. In other words, they can just pay off the bond tomorrow because the interest rate that is paid on the bond is actually higher than the current interest rate. So what they want to do is they want to get rid of high interest bonds. So what they may do is they may call the bond, pay it back, and then issue new bonds at the more current or market interest rate. So the call feature makes bonds a little bit less, for lack of a better term, makes them a little bit less attractive to buyers and sellers because they can be purchased back at any time. And so bonds without a call feature generally have a little bit of a lower interest rate because, they have a little bit of a higher interest rate because they compensate you for the fact that you don't run the risk of having the bond, called at any given time, and you don't have the ability to collect more and more compound interest on it. What are different types of bonds? Generally, there's three types of bonds. There's U.S. government bonds. Savings bonds are generally sold to the public in small denominations. We're talking $25 or $50 or $100. And so if you buy a $100 bond, for example, you actually don't pay $100 for it. You may pay $50 for it and hold it for 20 years. And you can buy those today. You can buy one right now at treasurydirect.gov, and you can buy a $100 bond for, say, $50, and then at maturity, that bond will be whatever the face value of the bond is. So, for example, here is treasurydirect.gov, and you can log into an account and you can buy U.S. savings bonds from that. So, U.S. Treasuries, and there's three or four different types of U.S. Treasuries. Treasury bonds have 30-year maturity dates, so these are long-term ones. So your retirement plan probably has some Treasury bonds in them. Treasury bills or T-bills have short maturity dates. Those tend to be up to 1 year. So they're sold at discount, which means that, let's say you buy a $10,000 T-bill for $9,000, and so you'll make $1,000 in interest. Treasury notes are paid 1 to 10 years, and then there's TIPS, Treasury Inflation Protected Securities, and the principal of those is adjusted by changes in the CPI. So there's no interest rate risk with these, because one of the things you deal with long-term investments is, let's say you buy a bond at 2% interest. Well, that's fine now, but what if the inflation rate goes to 3%? Well, now you're losing 1% every year on that. So what a TIPS does is that if the inflation rate goes up, obviously interest rates will go up as well. So it'll adjust that. Muni bonds or municipal bonds are issued by states, cities, or municipalities, or counties, as well as school districts. They're usually exempt from federal, state, and local taxes, so you don't have to pay taxes on these. As a result, muni bonds tend to pay a lower interest rate, but you don't have to pay taxes on the interest you make from them. And so they can be a pretty safe investment as well. Now, they're not as safe as U.S. Treasuries because the U.S. government, even though it's $20 trillion in debt, is never going to go bankrupt. But there is a chance that a city or a town or a school district will go bankrupt, and as a result, they may not be able to pay off the balance of that bond. Corporate bonds are issued by companies. There's 3 different rating agencies that rate corporate bonds, but generally you want investment grade bonds, which are AAA rated bonds, and corporate bonds, generally the better the rating, the lower the interest rate, therefore again the higher the price, right? Junk bonds tend to be like really low rated bonds. They're high yield, but there's a high risk of default. And so corporate bonds are riskier than municipal bonds because companies are more likely to go bankrupt than a city or a town or a school district that can raise money through taxes. Companies have to raise money by buying and selling goods. And we can see where a once popular company suddenly struggles and goes bankrupt. It happened to General Motors. 40, 50, 60 years ago, General Motors was pretty much a license to print money, and GM bonds were worth their weight in gold. Well, come 12, 13 years ago, the recession of 2007, General Motors went bankrupt. And so now their bondholders were not paid back in full what they were owed. So there are 3 different companies that rate bonds, and essentially those are the credit score for companies. You have your credit score, your FICO score that we've talked about earlier. A company's credit score is their bond rating. And so the higher the rating, the safer the bond, thus the lower the interest rate they have to pay off of those. And so when you research bonds, you want to look at the coupon rate, which is the interest plus the principal you're going to get paid back every year. U.S. Treasuries, again, they have almost no risk. Corporate bonds carry more risk and they are taxable. So one thing you could do is you can go to a bond screener. We're going to look at that here in a little bit. How do you figure out the value of a bond? Well, the yield is the annual interest rate. The coupon rate is the interest plus the principal you get paid back. The yield is just the interest rate itself. So how much would you make per year if you bought the bond today and held it to the maturity date? So the one thing here, you can see this formula on calculating value. It's also in your book. So you can take a look at that and figure out, okay, what is the value of a bond? And then also you've got to account for taxes, because remember, municipal bonds, there's no taxes paid on them. So the yields are lower, but actually you may make more money because you don't have to worry about that 20% going to the federal government or whatever. So what are the benefits and risks of bonds? Bonds are generally low risk, especially if you have investment grade bonds. And because they pay a fixed amount of cash interest every year, you know that you've got pretty much a guaranteed rate of return. And so one thing that investment gurus often encourage people to do is build a bond ladder that you should essentially get a lot of investments that mature in different years. And then when they come mature, replace them with bonds that will mature in future years. That way you aren't stuck, say, the market collapses at the time that all of your bonds are going to mature, or you're at a really difficult time at that time that all the bonds mature. So have a ladder. That way that mitigates your risk. It's the same thing as diversifying in stocks as well. And I would even say this for simpler things like a certificate of deposit at the bank. Don't just hold one, but buy one and then buy another one in 6 months that mature in a year. So you have a 1-year bond that matures in January or a CD, and one that matures in July, and then maybe do the same in April and October. And now you've got 4 and one maturing every 3 months. The bond ladder does the same thing. Buy them with different maturity dates. That way you have bonds coming due. And again, a lot of this you may not do directly. You may do it through your retirement plan, and the investment manager in your mutual funds that make up your retirement plan will probably do it for you. What are the different types of risks you have with bonds? One of the biggest risks is the interest rate risk, because the reality is that if interest rates go up, but if I buy a long-term bond at say 3% and interest rates go up to 4 or 5%, well, now I've lost out on that ability to make the higher interest rate, and my bond loses value because of the fact that it's not as attractive. And so I, maybe lose the ability to sell it. There's the risk of default if the company defaults. There's liquidity risk as well. With stocks, there's no liquidity risk at all. You can usually find somebody to buy your stock. But with a bond, the bond market isn't quite as active as the stock market. Some bonds have few buyers and sellers. Therefore, it may be hard to sell it if you need an infusion of cash before the maturity date. Inflation risk is probably the second biggest risk with a bond, because, again, if you got a 30-year bond, say, paying 2.5% interest, the inflation rate's 3%, well, now you're losing 0.5% of value every year on that. And any bond with a call feature may have to be sold back prior to maturity, so there is what we refer to as call risk. How to buy bonds? Start out, buy bond mutual funds. And I really, mutual funds are often the way to go. especially because we tend to be busy in our lives, let a professional manage your investments. So if you're going to be more passive, you can invest in a diversified portfolio, hold it, but get a financial manager or do it through your retirement plan, your 401k, or your mutual funds. There's also something we refer to as a target strategy. Align the maturity date with a savings goal. That savings goal may be, when are your kids going to go to college? So maybe you want to have an infusion of cash then. Or when do you plan to retire? And that's one that I've got in my mind. Okay, I know I want to retire around this time, so all of my investments are generally targeted to mature at around that time. And my 401k manager, my retirement account manager, is looking at that and is trying to time the investments to mature when I hit a certain age. You can buy U.S. Treasuries at treasurydirect.gov. There's payroll deduction plans like 401ks and 403bs. You can buy corporate bonds through brokers. It's a little bit harder to buy them because bonds tend to trade every few days instead of instantaneously like the stock market does. So let's take a look real quick at a bond screener. I've got one on Business Insider here. And what a bond screener does is it allows you to kind of look at what you want. So for example here, I want to say all issuers, things maturing in 0 to 3 years, yield less than 5%. Let's say, let's go corporate bonds here. Coupon rate, less than, I'll go 5 to 10. Currency, US dollars. Moody's rating. You can look at all the different. AAA means these are the best. C's, yikes. Those are really bad. So let's say AAA bonds. Let's see what we got here. I press send and there's nothing. Okay, let's go government bonds because I know these will generally work with these here. And what do we have? We've got a bunch of U.S. bonds here. So let's click on this one. It matures in 2022, so 2 years from now. It's trading at $119.05. And we'll come back here to this, the bond finder here. One thing you see here, the coupon rate, 7.625%. In other words, that's how much you get paid principal and interest each year. The yield, 0.83%. That's how much interest you make. Here's when it matures, November 15th, 2022. So, and bid and ask are essentially the prices that they tend to be bought at and sold at. So you might buy a bond at 104.799 on this one that matures in August, but you, if you're, you might sell it at that, but if you're trying to buy it, you want to, you'll end up paying 104.95 for it, for example. So the sell price is usually a little lower than the buy price, or the bid is usually lower than the ask because there is what we refer to as a spread that ends up being essentially the commission for the sale of the bond. So that's a quick look at bonds. If you've got any questions, obviously feel free to contact me, but hopefully this gives you a little bit more depth. Use this again to supplement your reading in the book and enjoy the week learning about bonds.